What's going on, Wealth Builders? My name's Charles Newton with Secure Harbor Financial, and in this video, I have the honor of speaking with Matt Branch, Jeff Kamke, and Chris Kirkpatrick of Life 180. And what we're talking about in this video is the importance of addressing the volume of interest. We're going to go over those details. We also talk about the infinite banking concept and how we can utilize that in our lives. We talk about the importance of having money in a safe vessel and how opportunities tend to become attracted to you when you have money available. So stick around for this engaging conversation, and I hope you guys enjoy it.
So today we're going to be talking about how we can utilize whole life insurance policy loans for more than just investing. So something that we all like to talk about on our channels and with clients is something that Nelson Nash created called the infinite banking concept, utilizing dividend paying whole life insurance. And I just want to have a conversation with these guys. Well, we all want to have a conversation with each other, and we're in the Life 180 Mastermind in the Dominican. Super cool to network with all you guys. You have anything to add?
Yeah, I mean, so many people get caught up in the uses of a whole life policy, and the truth is, it's basically the Swiss Army knife of financial products. There's so many different uses, and when you have that policy in place and when you have access to that cash, you can start getting really creative. And one of the things one of our mentors says is that when you have access to cash, opportunity finds you. Mm-hmm. So that paradigm shift and not like getting caught up in the weeds with how you're going to utilize your whole life policy will really just help you grow immensely. And it'll also make you a better investor, because having that access to cash and utilizing that policy, you're going to vet the investments that make sense and that don't make sense. So it actually makes you a better investor overall. You want to add to that, Jeff?
Yeah, I think for me, I just get so excited when we're working with clients because there's so many strategies that open up when we're talking about the use of the policy loan and how we can do that depending on what the use case is and what the objectives are of the client. It's just phenomenal. It gets me so excited. And that's one of the fun things. You kind of get to start with a blank canvas and paint whatever you want to do and use that in a very strategic way. And I know we're going to get into some of the fun different ways you can do that are different than just the old investments.
Yeah. One thing we were talking about off camera is the volume of interest versus the actual amount of interest you pay over a certain amount of period. For example, the car example, let's say if I finance a car 5.5% over 4 years and I pay it off in 2, well, my overall interest, I'm going to be paying less because I paid it off quicker. So people often the haters in the industry often are like, why would you borrow money from a policy loan? You're basically borrowing your own money. And I want some of you guys to answer. I want to hear your opinions. But I think after this video, you're going to understand why we do that and why we're looking just to own, control our wealth to give us more opportunity in investments, but also just to come prepared for more opportunity, if that makes sense. You guys want to answer?
Yeah. So one of the questions is, why would you borrow your own money? Like, it just doesn't make sense, and then pay interest on that. Well, one of the reasons why you'd want to do that, and it's something that a lot of people miss with the whole infinite banking concept, is that when you borrow money within your life insurance policy, the cash value of your life insurance policy, you are honoring the compounding effect that it has, because when you pull that loan out, the insurance company doesn't recognize that you pulled any money out. So the dividend return that you're getting is off the full cash value of your policy, right? So you can break it down really simply and show what it looks like if you compound with a calculator, simple interest calculator, compared to what it looks like if you compound your the cash value of your policy. So let's say that you have a 6% interest rate on your car loan, and you have a 4.5% dividend payment into your whole life policy. At the end of it, even though you're paying a higher interest rate on your car loan, because of the compounding effect, you actually have more money in your cash value of your policy. So it becomes that much more efficient. But in addition to that, what you get as well is if you look at the lifetime value of what that compounding will do. Because when you get a whole life policy, you need to be thinking in a long-term way, right? So what is the compounding effect over 40 years. Like if you were to just pull the money out of the bank, if you were to just pull 40, 50 grand out of the bank and plop it down on a car, you lost the compounding effect off that 40 or 50 grand, right? But if you were to let that 50 grand ride at a 4.5% or whatever your dividend rate is, you're going to have that much more money, and it's going to be predictable, and it's that much more powerful. So people lose sight of that one philosophy.
Absolutely. So I'm going to talk a little bit more about the volume of interest part. I love talking about this because it's one of those things that we're trained to see it so like narrow focus, and a lot of guys don't even, a lot of the gurus don't even talk about volume of interest, and it's kind of perplexing why that isn't part of the financial discussion. So, we get talked a lot about when we're going to get a mortgage, going to get a car loan. What do they always sell us on? Oh, it's the APR, it's the annual percentage rate. And hear this APY thrown around. A lot of people are like, I don't even know what that one means, but I'll focus on the APR. And 5%, that sounds like a really low number. So sign me up. Sounds really good. And, with a car loan, it's not as impactful in a negative way as like a mortgage would be. A car loan, I think in today's world, the average is like 60 or 72 months, I think. And now I think you can get 84-month loans because the price of cars keeps going up. And to fit your monthly budget, you got to keep stretching the loan out. So the longer you go, like you said, that 5% interest, or now we're probably into more like the 6 to 8 and maybe even upwards to 10 if you've got a lower credit score that people are getting into a loan for. And we don't ever think about what the volume of interest definition is that 5% this year, 5% next year, all the years of the loan. What does all those years of 5% add up to be? That's the volume of interest. And nobody's talking about that. So if I go buy a $50,000 car, and these are going to be not exact numbers, I haven't plugged these into a calculator ahead of time, but if you have a $50,000 car and you have a 60-month loan, you're probably going to spend another maybe $15,000 in interest, maybe more, depending on your interest rate. So that $50,000 car costs you $65,000, and that $15,000 is what you're speaking to. Is if you can accelerate the pay down of that interest, you only pay maybe $5,000 in interest or $2,500 in interest, and that remaining interest you get to save. That goes back into your financial system, right? You get to do other things with that money, and it's not just going to the bank making them rich. And my favorite one, I love talking about this one, is I'm reminded of years ago. I remember walking into a bank over in the west side of Michigan. I live in Michigan, and they had like a little easel up. You write on it with chalk, and it said, today's mortgage rate. And this was back when they were like in the 2-3% range. Today's mortgage rate is like 3%. And it's like, oh yeah, that sounds so low. Like, oh, can't wait to get a house and pay such cheap interest rate for access to money. And then the volume of interest calculation goes in. If you have a 30-year mortgage, at those low interest rates, you're still paying probably 75% of the value of your home. So if you bought a $100,000 home, you're going to pay an additional $75,000 in interest over the course of that 30 years. So I look at it from the reverse of if you actually had a sign when you walked in your bank that said, great news today, guys, houses are on sale today. The mortgages are so cheap. You're only going to pay almost double for the cost of this house. Come on in, sign up. If that was the way it was marketed to us, nobody would do that. Everybody would be like, well, I don't want to. Why would I want to pay an extra 75 or 100% the value of my home? That doesn't sound like a very good deal. And those are the factors that show up in our life that are almost invisible because we're not taught to look for it. We never do the math. We just think, oh, it's just 2% this year. How could that have any adverse effect on my finances? When in reality, that's one of the biggest things that like Nelson Nash and the infinite banking concept talks about is the interest and how it erodes our wealth because we're always putting that interest towards somewhere else instead of taking control of that function with the policy loan feature and the whole life policy.
Yeah. No, I think it also goes right back to one of the biggest principles of making money, which is just pay yourself first. And I think infinite banking specifically allows an individual to take full of advantage. In our last video, what we talked about is like the home equity line of credit example. There's so many ways to kind of like the infinite banking concept where people leverage the equity out of their home. The reason why we choose whole life as that vehicle is because we never actually touch our wealth. And there's such amazing borrowing ability where you could borrow up to 90. I know in Canada, up to 100% using the third party, which some people are like, that's not infinite banking, but there are workarounds around it. And I think it's just getting creative and going back to what you said, It allows you to think creatively and more abundantly because you know you're never actually touching your own capital, which just goes back to the principles of making money, which is never touch your own capital. Use other people's money, OPM. All of the people in this industry talk about it, and you can use it for any way you want. No one's stopping you from going and using it for vacation. But at least, let's say if that $3,000 vacation, it costs you $3,000, that money's not coming out of your own pocket. And when you want to pay it back, you're still growing that $3,000 in another place. And that's the power behind it.
Yeah, 100%. So I have actually combined velocity banking, which is using HELOCs and lines of credit, and infinite banking, and I've married them together. So I'm living, breathing example of how powerful this strategy can be. So how it works is all of my cash flow goes into my first lien HELOC of the investment property that I have in Alabama. And so what's happening is, even though I have a higher interest rate, it accrues on a daily basis. So because I'm saving more money than I'm spending, I'm driving down the balance of that mortgage. And by driving down the balance of that mortgage, I'm reducing how much interest I'm paying on that money. Mm-hmm. So it becomes like this snowball effect where more and more money gets driven into this loan, and it just keeps going faster and faster and faster. So then what I do is I'll fund my whole life policy with the HELOC. Mm-hmm. So I'll put a big chunk of money into my whole life policy, and now I have that cash value. So then what do I do? I pull the cash value out and I put it back into the HELOC, mm-hmm. and that's at a lower interest rate. And I have the uninterrupted compound interest of that whole life policy. And over time, my whole life policy is carrying the mortgage, and it's much more stable. Yeah. And then check it out, guys. So now I'm paying my whole life policy at a lower interest rate, but now I have this first lien HELOC. I have all this money to go out and implement on deals. Like if I see something, boom, I can go out and create that deal, make a few thousand, make $10,000, $20,000. And then I just keep doing it, like start paying down the whole life loan. Mm-hmm. So it becomes like this cycle where you're just getting ahead of it instead of having the system working against you.
I have a really awesome mentor in Canada, and she always says there's one thing real estate investors always run into, and that after a certain amount of properties, they run out of cash flow and they have to build it back up. What whole life insurance, and specifically dividend paying whole life insurance, allows you to do, because no policy structured the same, is actually keep that capital building while you're working on other projects, just like you were saying. And when you get really creative about it and start leveraging the home equity line of credit to dump down on the HELOC more aggressively, you can eliminate that interest that you were going to pay out, recapture it in the whole life policy, use the cash value of that whole life policy, then go expand business outwards. So you're always doing more than one thing with your money. And people are like, well, why wouldn't I? Like, this goes back to why we were talking about, why would you use this vehicle rather than just a savings account? Well, my $3,000 I use for vacation, I'm going to just keep saying it, is never actually leaving my control. It's getting, we're still going on the vacation, but now I know my $3,000, once I pay it back, it's actually going to be, by the time I pay it back, $3,200. So on in long term, that 200 grows to hundreds of thousands of dollars because the compound effect takes place. People don't realize, they can only think, like most people think in the 2 to 3 year range. No one thinks long term, like 20, 30, 40 years. So the way that you guys think about it and the way I think about it is just going to keep paying dividends back to us, because our thinking is aligned with use other people's money, keep our wealth working for us, stop destroying the compounding effect. Every time you get ahead, you actually fall back, right? So what's up? This is Chris. Chris is here. Who wants to brief him?
What's going on? What are we doing?
What's going on, cash flow? It's Chris here with Life.
What are we doing?
So we're talking about the overall volume of interest. So just creative ways we can utilize, taking infinite banking and maximizing it, essentially, getting creative with it.
Yeah, I mean, he said it. Like, I think one of the things, we did a talk yesterday, and one of the things we were talking about is the fact that when you when you look at financial efficiency, I think we're able to look at volume and we can think about, all right, how do we just increase that efficiency without having to take on extra risk to accomplish the same long-term objectives, right? And so, I think what I talked about yesterday was like giving an example of like $100,000 income. Most people save $10,000 a year. They try to chase like an 8% return. They're taking a lot of risk on. So in this instance, they'd be saving or investing $10,000 a year and try to get $800 worth of growth, on this, taking a fairly significant amount of risk to do so. And I think when people look at that, they're like, holy crap, I didn't even realize that's what I was doing. Right. But that's the reality. Now people will try to say, oh, it's going to compound. It's going to grow. It's this, it's that, whatever. And it's also going to lose some years. And it's also going to go, like 2008, 2000, 2020, these kinds of things. Right. What I think, and I haven't been here the whole time, but I think what they probably are talking about is the fact that if you could just focus on increasing efficiency with the 90,000 that you have left after that 10 and thinking about, all right, what's the savings? How do I make my major capital purchases? How do I, have a reserve account for like, how do I pay for my cars? How do I, if I'm a business owner, how do I pay for major capital purchases like equipment? We work with a lot of dentists and a lot of chiropractors and people like that. And so, they need to buy equipment for their offices. And a lot of times, they're either paying cash or they're getting financing. Either way, there's a cost of capital that goes with that. There's a loss of control. And I mean, I did hear what Matt was just talking about a little bit as I was peeking through the window at the studio office here. And what I can say is like, he's 100% right. Well, if you focus on the volume of everything that you have go through your life, this just takes a little bit of a different framing. But if you think about that volume, you're like, all right, what if, I'm not saying you're going to make money, like, and I think it's really, you got to be really cautious. Like, we're not earning money on equipment we're buying. We're simply not losing the money, right? Like, and so what if you could recapture all the money you're losing buying these major capital purchases, and doing all these different things, buying your cars? If that's the case, think about all the money, the hundreds of thousands of dollars that you're going to be just like burning, giving to the banks and losing control of throughout your life. You're not going to eliminate the expense of the interest because that's the whole purpose of the policy loan. You're going to give that to the insurance company. The difference is you're recapturing that because your money is going to continuously grow. And that's the power. Does that make sense?
Yeah. I think we can end the video now.
Oh, sorry.
No. No, that's awesome. That's I think he just took everything that we were talking about and just kind of compacted. And do you guys have anything to add?
Thanks, sure. My final thought is so much of the time, and I talk about this in other videos too, like we're trained to be so singularly focused on looking at this one account and its one function. This is my savings account. It has one role. This is my 401k. This is its one role. And we're not taught, because I guess we're just too stupid. If you listen to Dave Ramsey, he just says we're too stupid to think differently than that. We just have this monkey brain that we can only do one thing at a time. And I know guys kind of are like that, right? We can only do one thing at a time, but we're smarter than just being able to focus on one aspect of our finances at a time and understanding this one role. And we never zoom out and we never see how all these moving pieces together. And like everything we've talked about, all four of us, has been that idea of let's zoom out. Let's look at how are these different things affecting each other and how can we take the lowest hanging fruit, the money that's already going away from us. How can we put in systems and strategies that are, kind of next level, but it actually lowers our risk. It puts us in more control, which are the two things most people want. They don't want to be more exposed and they don't want to give up control to somebody else. And so a lot of what we're teaching here is just putting ourselves in a power position with our finances. That's the bottom line.